British businesses lose confidence amid higher costs. Welcome to Market Insight. I'm Ludovica Brignola. British manufacturers have reported the sharpest loss of confidence since the start of the COVID-19 pandemic. All that in the face of higher costs, including tax increases by the new government. So what is the outlook for the sector for 2025? Well, to help answer all that and more, I am joined by Chris Beauchamp. He is Chief Market Analyst at IG Group. Chris, thank you very much for being with us today. Right, so we are seeing a sharp loss of confidence from the British manufacturers, largely driven by concerns about costs, as we said. Now, can you help us understand which cost are we talking about? What can be the impact that we could then see on output?
In terms of the cost, the most obvious one, and one that isn't going away, is rising labour prices or rising wages. It's a point that should be underlined this week when we get the UK employment data later in the week, but as you say, it was flagged by this morning's PMI figures that really show a lot of concern about the direction of travel for wages. You've also got the rising transport costs and higher raw material prices, and also higher energy costs across the board. So British firms face quite a substantial challenge, really, in terms of managing these higher costs. It's something we're not alone from, because the Europeans are reporting similar things, really, and tight competition means there's not too much room to cut costs, to raise prices rather in response. Right. So I think this is the crisis of confidence really coming through for the sector, and I don't see that ending anytime soon.
Right, so challenging environment for the sector. However, the general consensus for this week seems to be that there will be no rate cuts. Do you agree? Why is the Bank of England in no rush to cut? And what's your outlook for the continuation of the cutting cycle next year?
So none this week, but I suspect we see more next year. Now, Bailey's expectation is we see 4 in 2025, or 25 basis points ago. The market's currently pricing about 3. I think we might have to see a bigger move to the downside, and mirroring the 50 basis point cut we'd had from the Fed earlier in the year. And I think that the pressures in the UK economy, the increased wage costs being cited by a number of companies in their latest corporate statements, suggests that we're facing a more sustained slowdown in the UK economy, in employment, and I think the BOE may find itself in the position where it has to respond to that. And if it's an environment of weakening growth but also rising prices, that's going to make life very, very difficult for Andrew Bailey. But I suspect the second half of next year might well see a need to be more aggressive in rate cuts. And I think the Bank of England will just have to hope that prices do start to come down and give them just a bit more leeway on those two.
Right. And in the meantime, well, at the same time, actually, the Fed is expected to cut by 25 basis points, but they also update the projection for next year. Now, do you expect any meaningful changes to those economic projections or not?
I don't see many changes to the projections. I think it's the tone of the language we need to watch when the statement comes through, and obviously potentially the dot plot as well. See whether there's any moderating of expectations for 2025. It seems like the cutting cycle, if only just got started, is already going to be stopped in its tracks. While CPI last week for the US was okay, it still shows some worrying signs that prices are beginning to tick up again. And I think with new administration, new policies coming in, I think you may see a more guarded tone from the Fed that says essentially, we're still seeing very good growth in employment, and just because inflation has begun to tick up again, we're having to sort of switch back to the other half of the mandate and be a bit more cautious on talking too much about more rate cuts in 2025.
Right, and finally, going back to the UK, I think it's fair to say that UK equities have been lagging recently. However, we are seeing some analysts upgrading their outlook. Now, what's your take on that, and what do you expect for next year? Will anything change? Is there an opportunity there?
Well, there is in terms of valuation, but this is a story that's been with the FTSE 100, FTSE 250 for a while now, really. I think this year is both interesting because the first half of the year was really a story of strong UK performance, because it's almost as if the market collectively finally noticed the low PE ratios and low valuations on offer for UK firms relative to their US counterparts, most obviously. The problem is the second half of the year was very much a case of worrying about the UK economy, and that slightly diminishes the attraction of those companies. Now, with names like Ashtead upping sticks and going to the US, mainly because of the valuation discount, I think there'll be more interest in UK companies from a long-term play anyway, if only because you've got US stocks trading at such essentially eye-wateringly expensive levels, really, that the UK can only become more attractive by comparison. Investors putting money to work in the UK shouldn't be too optimistic about growth, but it perhaps looks a better bet on the risk-reward side in terms of valuation than it does in the US right now.
Very, very interesting insight. Chris Beauchamp, thank you very much for being with us today. Chris Beauchamp there from IG, and that is your Market Insight. Don't forget you can watch more videos on Reuters.com.